Jamie, we were talking about the fact that you have lent into technology over the last decade, billions of dollars invested across the business. When it comes to AI, which parts of the JPMorgan business are going to be most transformed by AI?
Yeah, so we've been doing AI since 2012. So people think it's like a new thing. Gen AI is kind of new, but not all of AI. We have 2,000 people doing it, spend $2 billion a year on it. It affects everything: risk, fraud, marketing, idea generation, customer service, and it's kind of the tip of the iceberg. And so we're deploying it. Every time we meet as a business, we ask, what are you doing in AI? What are you doing to serve your people? Why can you do better? What is somebody else doing? So we're freely deploying it, and safely. We have a lot of rules and regulations in place about our own data and how we use it, et cetera.
Is it having a material impact on revenues for JPMorgan? If not now, then when?
So we have shown that for $2 billion of expense, we have about $2 billion of benefit. Some we actually can do real detail. We did this, we reduced headcount, we saved this time and money, we reduced errors. Some you can't. It's just improved service, something like that. It's like almost worthless to say what's the NPV, but we know about $2 billion of actual cost saves. And like I said, I think it's the tip of the iceberg. We're getting better and better at it. We know how to do it. As the managers learn how to do it, they're asking more questions. Why can't it do X and why can't it do Y? And then I don't have my phone here, we have a suite, an LLM suite on internal data to do research and summarize reports and scan contracts and do things like that. 150,000 people a week use it. So it's quite productive.
More and more of your employees are using the agentic AI across JPMorgan.
Our own LLM, and agentic is just starting. But that will be deployed over time too. But it's also being used for coding. I mean, it's being used quite broadly now, and like I said, part of it is getting your mind working around how you're going to use this thing, and so our managers and leaders have to do it.
If you look out 5 years, are there more jobs in banking as a result of AI or fewer?
I think people shouldn't put their head in the sand. It is going to affect jobs. So think of every application, every service you do, you'll be using AI. Some to enhance it, some of it'll be you doing the same job, you're doing a better job at it. There will be jobs that it eliminates. But you're better off being way ahead of the curve and retraining people. So we retrain and redeploy a lot of people. So for JPMorgan, if we're successful, we'll have more jobs. But there'll probably be less jobs in certain functions.
When you look at the spend on AI, infrastructure, chips, OpenAI, it's not making a profit. Loss-making, deals of about $1 trillion this year. The hyperscalers, the spend there. What is your reaction when you see those numbers crossing? Are you comfortable with that kind of spend on the infrastructure around AI?
It's a lot. I'm not sure it's all ever going to be totally spent. I think when you look at big tech, like tech that happens like this, and you go look at cars, you could look at television, you could look at internet, big money's got spent. There were a lot of losers, a lot of winners. In total, it was productive. So even take the internet bubble. Remember that blew up, and the amount of people. You and I could probably name 100 companies that were worth $50 billion and disappeared. But out of it came Facebook, YouTube, Google. So there will be real big companies, real big success. It will work in spite of the fact that not everyone who invests in it is going to have a great investment return.
And of course, those investments are part of what has powered this bull market in stocks. And on Sunday, it'll be 3 years of that bull market. Where do you think we are in that bull market? Is there any complacency there? Is it underpinned by rational factors? Is there more momentum?
Yeah, look, we're in a bull market. It's been clear. Asset prices are high, credit spreads are low, consumer's still okay, the consumer has jobs. Remember, jobs is what usually starts to force people to cut back and change things, and consumers spend less and companies cut back. So far, so good. There are a lot of issues out there that the economy's got to deal with, from all the geopolitical stuff. Maybe that'll start out well. What's going to happen to inflation? I'm a little more nervous about inflation not coming down like people expect. That might be a surprise. On the other hand, there's a lot of spending. There's a lot of government spending, which is inflationary too, by the way. And so, look, I don't know. I hope for the best, plan for the worst.
And you're not worried about a recession in 2026 for the US? You made that clear.
I think it could happen in 2026. I'm not worried about it as a different statement. We'll deal with it. We'll serve our clients. We'll navigate through it. A lot of us have been through them before. You don't wish it because certain people get hurt, but it could happen in 2026.
We're still, of course, in the US government shutdown.
But I do think there are positives. Like deregulation is a real positive, which also helps animal spirits as a positive. And in the one big beautiful bill, there's also more stimulus that has positives for the economy, but maybe negatives for inflation. So how it all sorts out, we'll see.
markets are looking through the US government shutdown. Is there a period of time, if this shutdown continues, where markets start to wake up and become concerned?
I don't think so. Look, I don't like shutdowns. I think it's just a bad idea, and I don't care what the Democrats, Republicans say. It's a bad idea. It's not a way to run a railroad. I don't think it's critical. We've had, I forgot the number, 4 or 5 or 6. One of them went for 35 days. I'm not sure anyone really affected the economy and the market in a real way.
You mentioned inflation. You said you're a little bit more concerned about inflation than maybe some others. Markets pricing in about 100 basis points of cuts between now and this time next year from the Fed. Does that therefore seem reasonable to you, or markets are over their skis in pricing?
I think markets have to make a forecast. I want to point out that forecasts have almost always been wrong, and the Fed's been wrong too. So it isn't like their forecast is going to be accurate. If inflation goes up, starts ticking up for whatever reason, and it might, it's going to be hard to do 100 points. They might do some, and then they have the battle, the give and take of if unemployment starts going up, well, obviously they're going to do some. So we'll see.
You've long talked about geopolitics as being a risk factor. We're seeing gold at $4,000. We're seeing Bitcoin at record highs. The dollar, though, year to date, down about 8% on the Bloomberg Dollar Index. Are you seeing structural shifts out of the US dollar, and is that a sustained theme?
A little bit, but again, I wouldn't have heartburn over it. The dollar did well for a long time. If you own U.S. stocks, so foreigners own something like $35 trillion of U.S. stocks and bonds, and because the stock market's gone up, your allocation to the U.S. has gone up. I think it's perfectly reasonable for investment committees in Europe and around the world to cut back a little bit of their equity ownership. We've also seen people changing their hedge ratios and stuff like that, so it may just be a rational adjustment to, I don't expect a stronger dollar, the tariffs has this effect, but it's still, if you look at America, it's still the greatest place in the world to invest long term.
And deal making seems to be picking up. And of course, JPMorgan played a significant role in the takeover, the take private of EA, $20 billion in financing provided by JPMorgan. Is that a marker in the sand? Is that a one-off as a deal of that type, or is it a sign of more competition between, frankly, the banks and private credit?
Well, look, we're agnostic about private credit, so there may be competition or not. We want our customers to do what's in their interest. We offer both, and we did that whole deal in 11 days, and we didn't do it that way to make a point to private credit. If they had said do it differently, we could have done it differently too. And so, but there's a lot of merger talk. There's a lot of firepower. There's a lot of tech. We had a bunch of IPOs in the U.S. And I know there've only been a handful here. The tech world is still doing quite well. The 800 companies here. I think it was 400 last year. We now have 500 bankers coming. The innovation economy globally around the world, including we've added like 50 alone here. So. Look, I'm a long-term optimist. I do think asset prices are high, credit spreads are low, and you should take that in consideration how you think about the future.
When we talk about credit and you talk about debt, I'm thinking of some data, in fact, that JPMorgan put out on auto loans. Biggest losses in the most recent months, I think since March of 2020. Is that idiosyncratic to auto loans in the US, or are you seeing other weak links being stressed?
I think there were 1 or 2 frauds, which I won't go through, but in general, consumer credit was so good. It's basically, most of that's just normalizing for both credit card, but subprime order is a little bit worse than normalizing. It doesn't look like it's getting worse from here, but it might. But a lot of that, if you look at the history of credit for consumers, it's employment. It's when employment or home prices go way down, which we don't maybe not expect, that drives credit.
The administration is talking about possibly changing the requirement around quarterly earnings. Yeah. And you've talked about this, you've written about this with Warren Buffett around the guidance part of earnings and quarterly guidance. Would you welcome a change like that? And would it mean a change at JPMorgan in terms of how often you update
I would
investors?
welcome it. We still probably update investors quarterly with much less stuff, and we just be very transparent. I think the bigger problem wasn't just reporting quarterly, it was forecasting where CEOs get their back up against the wall, they have to meet these things, earnings, and they start doing dumb stuff to meet earnings, and that kind of public pressure. I think it's a smaller part of a much bigger problem. We've gone from 8,000 public companies in 1996 to like 4,000 today. And that, I'm not sure that's good. We drive companies out of it. We have cookie cutter governance. Some activists are good, but they're activists. There's litigation. There's cookie cutter compensation. There's very expensive listing. There's disclosure rules, which you've heard about them here. I mean, endless rules, and that it makes it hard for a small company to go public. So I think, and they're trying to do that here, have an active small company going public. That's what we all need. and they create an equity culture, which Rachel Reeves was trying to do here. And I think they're doing a good job reducing regulations, trying to make it easier to do business, and reducing regulation in banks, but also in business in general. You want an active market, and we've kind of crushed it. And because the research laws and MiFID and disclosure requirements. So if I was a regulator, I would take a step back and look at the whole system and say, how can we improve it and make it safer? And look at it holistically as opposed to just everything's like a one-off conversation.
I need to talk to you about some other changes that the Trump administration has taken. You are a champion of capitalism and free market capitalism.
Yeah.
So when you see stakes taken by the administration, or the US government, let's put it that way, in terms of Intel, golden share for US steel, investments in a lithium mine producer, how does that sit with you?
Yeah. So the first thing is there are legitimate complaints around trade. So just take that first. Some are around just unfair trade. It's unfair to use, it's not just tariffs, it's surpluses, it's capital, it's quotas, it's just, it's the non-tariff barriers. And then there's national security related. So I think in national security, you have to take some special thing. I call it industrial policy, but it's got to be done right. It's got to come with permitting, no virtual signaling. And so like the deal that was done for MP, I thought they did a very smart thing. They're giving MP, which we were part of banking, does rare earth magnets, because they're going to have a long-term contract with the government, it gives them a chance to survive, to get through it. They call it the valley of death. And they bought a piece they're going to do that. So I thought that was really well done. I'm not going to comment all of them. I think you have to be very careful when you get involved in that kind of stuff. Why are you doing it? What's the long-term benefit? And then, of course, if Democrats get in power, they're going to do even more of it. So I would be very cautious about how you go about that. I do think they need to do more. You cannot do certain things in the United States. You think a company's going to do it, they'll be bankrupt in 7 months. They either need free land, cheaper financing, and maybe the most important thing is long-term purchase agreements with defense or companies or something that gives them a real chance to build a business.
You touched on the fact, look, we're here in the UK. The Chancellor was here. She addressed the summit. She addressed the conference. She's making those changes. Is the UK doing enough? There are going to be potentially some changes when it comes to listings. They may be announced in the budget in November. Is enough being done to make the UK, to make London an attractive listing destination again?
Well, first of all, something here, it's a wonderful city. It's a melting pot. The brain power is extraordinary. And I'm talking about not just financial, but lawyers and technology, media. It's unbelievable. It's a huge benefit to UK, though I'm not sure the rest of the UK appreciates that much. And they're saying the right things. They're deregulating. It's not just banks, but business in general, reducing red tape. I call it blue tape now. They're reducing red tape, blue tape. They're trying to consolidate the pension and savings schemes, which I think is very smart. Have a little more of an equity risk culture. Not to lose money, but to take a little more risk. And maybe some of these tech companies here. Yeah, I applaud everything they're doing. I know the public here doesn't applaud as much as I do, but they have to keep going.
H-1B visas in the US, talking about attracting talent, $100,000. Is that a barrier to the US tech sector? Are you concerned about that?
No, I'm not. Again, I could harp on it. It's 600,000 employees. That's it. We have 160 million people working. And I do think, these things happen. I didn't like it when I first started. I still don't particularly like it, but you know what? It was being abused. We did the analysis and the work. It was not supposed to be to bring cheaper workers here to make more money for your company. It was meant to bring very talented people in that you don't necessarily have for your company. And we may have made some mistakes, but let's just fix the system. I was with the president once, and he said more merit-based, more merit-based. In fact, I heard him say we should stamp a green card in every person in this country who went to university or advanced degrees and have them stay here and build their career here. That would be my belief. I want them to go back to that, not make it harder to be or make it easier for real merit-based.
You speak to the president every week?
No.
Okay.
I've spoken to him a couple of times.
Jamie Dimon, Chairman, CEO, JPMorgan, thank you very much indeed. Really appreciate it.